It's very difficult to find long-term investable companies in the industrial sector. A lot of the companies are cyclical, and a lot of them are unknown. But there are some hidden gems in the sector. Hello, everybody. This is Chuck Carnevale, co-founder of FASTgraphs, the Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. This is part 5 of my continuing series on the 11 sectors under Standard & Poor's GIC. And in this video, we're going to cover the industrial sector. And this is kind of a difficult sector because a lot of names are not really household names that are, in the industrial sector. And it's very hard to find good companies, especially companies with consistent growth of either earnings and or dividends. But there are some names to be found in there. And the reality of it is, when I was screening for these, I screened with some very specific parameters. Now, I've had subscribers ask for me to go over those screens. So before I start this, I'm going to show you the parameters or the screening parameters that I chose just to identify some companies that made sense from a valuation perspective. But then I'll also show you some adjustments that can be made on the screens which change things dramatically. So let's start by going into FASTgraphs here and going into the screener. And here I named this screen Industrial Total Return. Now, I had 5 categories in the general sector. Of course, I was looking for industrials. I wanted them to be primary companies. I looked for PE ratios lower than 15. I did videos on this where, a 15 PE is an earnings yield of 6.5 to 7%, 6.67% to be exact. And that's basically the minimum threshold of earnings yield that I'm willing to accept as an investor. In other words, if the company paid me 100% of their profits, my earnings yield would be 6.67% or better. I'm looking for companies that can deliver that. So I fudged a little bit and I just asked for an earnings yield of 6%. And then I looked for an adjusted operating earnings persistency of at least 60%. So I was looking for some of the more consistent stocks in the industrial sector. Now, in the historic section of the screener, I only looked for positive growth over the last 5 years. And then in the estimated section, I looked for total return, which was relatively low. I was being generous with this screen. I looked for just greater than 5%. And then I looked for positive earnings growth. And then as far as regions, I limited this to United States and Canada. So this was basically the screen that I utilized for this particular filter. Now, when I run the query, I ended up with 16 names. And this, again, is a total return screen. So I'm going to close the filters here now and just go through these companies. Now, I'm going to put them in alphabetical order and go through them because it's easier for me to basically remember where I'm at when I'm looking at those. And some of these, now you notice I didn't do anything about dividends, okay? So I have no dividends on this screen. But then I also do an income screen, which I'll show you here in a minute. But this was total return, okay? And I'm looking for companies that gave me a reasonably high estimated total return. Growth rates had to be, positive, as all they had to do is be positive. And then my estimated rate of return over the next couple of years was actually pretty substantial in some of these companies. But let's go through them and kind of show you the nature of the beast. Now, I can do that by going through the quick view right here. And what I want you to notice on the quick view is performance relative to the S&P 500. Now, AG Growth International was the one that I have up here. That's AFNCA. And what I want you to notice is in 1 year, they underperformed the SPY. In 3 years, they outperformed it pretty dramatically. In 5 years, they underperformed it dramatically. In 10 years, they underperformed it dramatically. In 15 years, they were pretty close. And in 20 years, they outperformed the S&P. This idea of being fixated on performance against the S&P 500 is just something that's really, to me, impractical. Now, here's ABM Industries. Let's go through the same process. In 1 year, they dramatically underperformed. By the way, the SPY, as I've shown in previous videos, is fully valued to overvalued right now. These stocks are undervalued because they have PE ratios, below 15. You can see the blended PE ratio here is 13.20. In the S&P, the PE ratio is over 20. So I want you to take that into consideration. We're comparing value stocks versus an overvalued SPY. In 5 years, it came pretty close to a dead heat with the market. In 6 years, it underperformed again, underperformed in 7 years, and underperformed in 10 years. Now, go through this process, and again, you can see that Allient here was kind of interesting in terms of performance over 20 years. Let me make sure I keep this up. It outperformed. In 15 years, it outperformed. In 10 years, it outperformed. In the last 5 years, it underperformed and underperformed in the last years. Again, the idea is these stocks have come into fair value where the S&P is still being overvalued. Now, I'm not going to go through this with all of them for you because I just want you to get the picture that some of these have performance that outperforms the market over periods of time, and sometimes they don't. But when you look at the characteristics of these companies, now I'm going to use this particular company to kind of do something for a request that I've had from some of the subscribers to the channel. I'm going to take the FASTgraph apart. They say they have trouble interpreting FASTgraphs. FASTgraphs are very, very easy to interpret. You have the FASTFacts keys here. This gives you the basic information like the PE ratio, it's below 15. The earnings yield's above 6, 7.57. We do have a dividend yield on this stock. It's 1.96%. The earnings growth has been 7.7%. But that's because they had a surge in growth during the COVID area here. And now growth is expected to be dropping actually again, but it's expected to resume. So these companies tend to be that way. But here's the point. This is a 15 multiple of earnings. This is theoretically the fair value of the company. Now, if I put weekly closing stock prices, you should see prices following, tracking, or correlating to that orange line. And so when I put prices on here, you see that very clearly with ABM. There are periods where it gets fairly valued, overvalued, occasionally gets undervalued. It did that in COVID. Generally stays at a 15 multiple or above, however. And more recently, in the last couple of years, because of, again, dropping earnings, the stock has basically been undervalued. But again, notice the volatility. That's all the FASTgraphs is showing. The white line here is simply a plotting of dividends, and the area below the white line is how much of the earnings the company pays out, called the payout ratio. You can simply point to the dots here, and you can see the payout ratio in 2006 was 43%, it was 43%, 45.5%, 39%, so approximately 40%-ish of the earnings this company pays out. Now, when they had the earnings surge, their payout ratio was actually very, very low. Got into the 20% range and 30% range. But once again, this company's earnings have tracked the S&P. Going forward, looking at this company, we expect a down year in earnings this year, but because the stock is so inexpensive, it should still command a 15 PE. Once again, this is an analytical tool to think with. You can see how many times this stock's price has come back to that 15 PE. Now, the market value of this stock, the normal value the market has applied because of all these periods of overvaluation have been about 17. All right. Now, I believe the conservative line in this case, and in most cases actually, is the orange line. The normal multiple will draw a PE ratio over the last 5 years below the historical 15 PE. I do want to make that clear, but if I use this drop down here, that's been very unusual. And again, we saw that by seeing that for the last several years, the PE ratios have been low, but they've been consistently higher than that over the long-term history. This is what I mean by an analytical tool. I'm not real keen on this company. It is inexpensive right now. It doesn't have a credit rating. It has moderate amounts of debt, reasonably consistent record. But this is how you interpret FASTgraphs. The forecasting calculators give you estimates of analysts' earnings for the future, in this case, 2024. Now, this company has an October fiscal year. So they just completed their 2023 fiscal year on October 31st, and it was down, earnings were down 4.37%. They're expected to be down 5.37% and then rise again going forward. So FASTgraphs are very easy to use. They lay everything out there for you. So let's now, keeping all this in mind, I'm not going to go through this as closely as I have with this stock in the future ones. Let's go forward. Now we look at AFN. Now here we see a very cyclical company. We see dividends that are the payout ratios well in excess of 100%. If I look at operating cash flow, which you can also do with FASTgraphs, I don't see operating cash flow covered a dividend, so it doesn't surprise me that the company has cut the dividend. But obviously, this is not the kind of company that I'd be interested in being a long-term investor in. But it is expected to grow and has grown coming out of COVID. For the last several years here, it's had pretty substantial growth. If I drop it to 6 years, it's averaged over 20% growth. All right, forecasting going forward is for it to continue to grow for at least the next couple of years at over 15%. And we don't get a long-term growth rate. You often see that with very cyclical stocks like this. Analysts simply aren't willing to give you the long-term growth rate projection because, it's so cyclical. Now, interestingly enough, if I look at the analyst scorecard of this company, I want you to notice that the analysts have been wrong 58% of the time on a one-year forecast with a 10% margin of error and 67% of the time. So even though analysts are being very sanguine about this stock and really expect very high growth, I'm not going to put much credence in the ability for analysts to estimate this company. The next stock here is Allient. Now, this is a decent company. It's got a really good long-term growth rate. And the other question I get often by subscribers is, how come it changes when you change the growth? Because this is all functionally, these lines are drawn based on the company's growth rate. So if I drop this to a 20-year graph, growth rate actually accelerates because I've cut out a low year. If I drop this to a 15-year graph, now we've had the growth rate dropped to 15%, but it's still very high growth relative to most companies. I drop it now down to a 10-year. Now, this includes 2 year of estimate data, so I only got 8 years of history here. Our growth is 12.87. The forecasting graph, the analysts expect, and there are only 3 analysts following this company, they expect 13% growth going forward. And once again, analysts have been wrong about this company way more often than they've been right. So this would be one that would be very, very difficult. Doesn't really pay much in the way of dividends, but you want to use this to analyze this tool to analyze this and see where it is. The one thing going for it, it's inexpensive right now, trading at a 15 multiple. But because the earnings growth rate is over 15, I want you to notice that we're drawing the orange line with a 16.95. You get all of the information you need in the fast facts and the graph key information here to the right of the fast graph. Easy peasy. The next stock we want to look at is Brinks. Brinks is very interesting. Now, I want you to notice again the nature of industrial stocks. If I go just for the last 10 years, this company has had a really beautiful growth rate of almost 20% a year. And on that basis, it's very, very inexpensive. And it's kind of inexplicable because the company's growth has been double-digit growth during this period of time. But the market is putting low valuations, 10 multiples. Currently trades at a 12.84 multiple. It's theoretically possible because of historical precedents that it could move up into this 18 to 20 multiple. Once again, we're drawing the orange line here with a 19.87% multiple. That's the PE ratio equal to the company's growth rate. Doesn't pay much dividend, has a very low payout ratio, but it has, a very interesting looking future here. It's only BB rated, has large debt, and the analysts have been reasonably good on this particular one. But once again, there aren't many analysts following this stock. And so I think you would have to take that into consideration. Now, this looks like a very intriguing investment. It is a decent company, by the way. And by the way, another beauty of FASTgraphs that you can just go into the external links here and go right into the company's website, and then you can learn about what the company does. What Brinks has, cash management, global services, industries they serve, are, international businesses or diamonds and jewelry, electronics, precious metals, fine arts, where they store and ship them. They have financial institutions. They do ATM services, branch services for like banks and savings and loans and things. And then retail, they also have restaurants that they serve, and so on. So a lot of people are familiar with the Brinks. The point is, it's a decent growth rate, very low payout ratio. And again, analysts, miss estimates here about 25% of the time on the 2 years and about 16% of the time going forward. And the forecasts here are for very high growth. But again, I would look at that with a jaundiced eye. All right, now I'm going to kind of go quicker now through this. We're looking here at BECN Roofing Company. This is more of a growth stock, pays no dividend. They did apparently pay a dividend once. I want you to notice that it's been growing very fast coming out of COVID, but I also want you to note, but using the tool to think with, that, growth has been pretty cyclical historically and relatively high. But if I take out some of this high growth, I only have 5% growth during this period. Now, this has a September fiscal year. I want you to notice that FASTgraphs doesn't really pay much in the dividends, and this is kind of a very, difficult company to basically invest in for the long term because it's all about the capital appreciation. But once again, I've got this 15 PE ratio valuation reference line, and I can see that 15 multiple has been awarded this company most of the time. It's currently trading at 11 multiple, and yet it has some of the biggest growth prospects that we've seen. Now, I also want you to notice that there's an error here because adjusted operating earnings, they probably didn't report it. So if I go to GAAP earnings, now I have to shorten this time frame so I can see the data. Again, you use this as a tool. The fact that it's so proactive allows you to manipulate the time frame so that you can see what's going on. They really lost a great deal of money during COVID, and their diluted earnings, their GAAP earnings, they're down, this year as well. You want to check that against things like cash flow, and we also see that cash flow has been relatively spotty, but yet a lot more positive, if you will, than earnings have been. So that would be BECN Supply Company. The next company here is CSG Systems. And again, if I max this out, you can see that, some of the issues you run into. But for the last, 15, 20 years or so, the company's had reasonably consistent growth, but at a relatively low rate. A 15 multiple, has been awarded to stock in the last several years. Prior to that, coming out of the Great Recession, it was really given really low multiples. They started paying a dividend. Look how FASTgraphs just instantly illustrates that for you. They started paying a dividend in 2013, and they actually have a pretty nice dividend record, and they currently offer kind of a market neutral-ish yield of over 2%. And, if I look at long-term performance, the dividend has grown by over 10%. The stock, has underperformed the market in all categories, but it's just now starting to be a dividend stock. And so if I looked at it just from the last, few years since they've started paying a dividend, it was relatively undervalued. I get a pretty decent rate of return here of about just under 8%. And I get a nice dividend record where I've had good dividend growth. Anyway, that's CSG Systems International. The next one we want to look here is Genpact. This is probably the best of the breed. It actually has an investment grade rating. It only has 39% debt, 1.5% dividend yield. Started paying a dividend in 2017. This has been a pretty consistent grower, historically. I'm going to cut a few years off. It's been a double-digit grower, but it does have moderate cyclicality. I want you to notice that. The forecasting graph is for 9% growth going forward. Analysts have gotten this one right most of the time. This would probably be one of your higher quality companies in the industrial sector. And again, you can go into the company's website and you can learn about what they do and how they do it. And, various industries that they serve, banking and capital markets, consumer goods, healthcare, high-tech, insurance. And again, you could spend some time in the website and learn. It is very inexpensive right now. The PE is only 12.8. It does offer a very attractive future rate of return. This is probably one of the industrials in this group that I like the best and would actually consider it investable here, depending on your, goals and objectives and risk tolerances. The next is GMS. It's a trading company and distributor. Market puts a low valuation on this stock historically. There's nothing but growth here. There's no dividends. And, the forecasting calculator shows very low growth. But the analysts, have been relatively successful. But again, they've only got 8 or 9 analysts on this company. I'm probably not real interested in a stock like this. I consider the uncertainties here too high for me to be intrigued by it. Gates Industrial is a good example of a cyclical industrial company. You can see the earnings go all over the place. Analysts have missed earnings 75% of the time in the 1 year, a third in the 2 year with margins of error. It is expected to grow a little bit, But once again, when you're looking at 12% growth and analysts missing the 1-year growth 75% of the time, and there are only 9 analysts following the company, I wouldn't be too sanguine. This is a tough industry to invest in. Here's Hillenbrand. Hillenbrand is a pretty consistent company. It's not necessarily a real fast grower. It's inexpensive. It's only BB plus rated. It has about 55% debt. It has a pretty good estimate record, but again, you don't see a lot of long-term investable stocks in this sector. Here's Jeld Holdings. Again, it's only been providing data since 2017. It was really highly valued. You can see the volatility here, but you can see how the company is tracking earnings and how changes in earnings can really be impacting the stock price. Analysts are expecting earnings to grow going forward. But once again, I want to remind you the estimates on this. The analysts have been have a very, very poor record estimating this company, but there are 14 analysts that are following it. Next stock on the list here would be 3M. 3M is one of the higher quality stocks in this industrial sector. They've gone through some issues with some hearing protectors they built for the military. The stock has gotten very inexpensive. They've maintained their dividend record. The growth rate has slowed down here recently compared to historical norms, but it does offer a 5.6% dividend yield. I like this stock. I'm long on this stock. I think it's very attractively priced here. I think it's a very high-quality company. It's just short of an A rating. That's going to probably recover. When I look at forecasts, there are 15 analysts following the company. They have a really excellent long-term track record. It's only been the last couple of years where they ran into a little bit of trouble with some chemicals as well as the hearing protectors that has caused the stock to really drop. I consider this a long-term opportunity that, has some short-term issues, but I do want you to notice the stock has been recovering really nicely. The next stock is SS&C Technologies. That's only BB rated. It has a 1.6% dividend yield. It has a very good earnings record, although it does have a couple of years of flat earnings. And look how that's impacted the stock price. Forecasting calculators on this stock look for a 12% growth going forward, and the analysts have a very excellent record of getting it right, and there are 11 analysts following the company. So this is one you might want to take a closer look at. The next one is Sensata Technology Holdings. It's electrical components and equipment. You can see, there's been some cyclicality here. During COVID, the earnings dropped dramatically, and of course they recovered. Now they've had a drop in earnings based on a weak year in 2022, but analysts are expecting, growth going forward of about 11%. They've had a pretty good track record as far as forecasts, so this would be one that you might want to do some additional due diligence on. The real salient point here is I think there's a real high margin of safety with a 10% earnings yield and a PE ratio under 10. The next stock here we're looking at is Textron. Textron is one of the higher quality companies in the industrial sector. Since coming out of the Great Recession, it's actually put together a pretty consistent record of earnings. Of course, they did have a drop during COVID. This is, again, a growth vehicle. It's not really an income vehicle at all. They're forecasting just under 10% growth. They have a pretty good record, the analysts do, of forecasting this stock, and there are 15 analysts that are following the company. The next stock is V2X Inc. They are aerospace and defense company. This is the kind of stock that, if you don't know, I don't know anything about this, you go into the corporate website and you learn about the company and what they do. So it's aerospace and aviation, training, etc. They don't have much of a growth record. They're pretty cyclical. The stock price has really not gone anywhere, over a long period of time. Now, if I go back into my screen here and look at it from a standpoint of the pop-up here, you can see they've dramatically underperformed the market in 1 year. They really underperformed it in 3 years. They outperformed it in 5 years. They've underperformed the market in 10 years. And then, they don't have a 15 or 20-year record. My point being is that this is a pretty cyclical company. Now, to kind of round off this, video on the industrial sector, I want to talk about the screens again a little bit. As I mentioned, I told you what filters I use. What I was looking for here are just representative companies in the sector. And I just kept the screen very, very minimal. But watch what happens here if I do a couple of things. For example, I had the PE ratio of low, less than 15. If I change that and call it high above 15, but yet I still want a minimum earnings yield of 6%, and now I run the query, all of a sudden I end up getting names that were not on the first list, and I actually get much better names. For example, let's look at Snap-on here. I've got Snap-on, it's A- rated, only has 20% debt. The PE is 15.4. This would be an excellent company in the industrial sector right now, I think, to invest in. I think it's reasonably inexpensive. Close these filters now. The next one would be Middleby, another really excellent company, more of a growth-oriented situation. They struggled a little bit in COVID, but this company has put together a really excellent long-term record of over 20% earnings growth. The forecast going forward is much more sanguine at only 8% earnings growth. Long-term growth in this company, however, is expected to be 10%. This is a very good company with moderate debt. They do not have a credit rating because they haven't applied for one. But Middleby makes industrial machinery, supplies, and components. Again, if you're not familiar with the company, you can go in right through FASTgraphs into the company's website, and you can see they make things like commercial food service products. They do make residential products as well as food processing products, innovative kitchens, etc. It's actually a pretty well-known company and pretty interesting. MSC Industrial Direct is not a company I'm very confident in. You can see their dividend payout ratio has gotten real high. This is the old Raytheon United Technologies merged company. Most of this historical graph would be the old United Technologies. It did, falter a little bit during COVID, but it's back on the growth train. PE ratio is 16. I would have been a buy back here when the PE got to 14.56. But what I'm really showing you here with these examples is how you can just change the screen just ever so slightly. I'm just going to go through one or two more here. I'm going to go through Science Applications International. It's got a decent growth rate. It's just a little pricey now, but it was an inexpensive stock just a couple of months ago and maybe even a year or so ago. But anyway, this has been part 5 of my look at all the various sectors, the industrial sector. Like I say, there are some gems in here. I find it very hard to find value in this sector right now. It's hard to find good income stocks here because of the cyclical nature of the industry, but there are some. I cited 3M, as an example of a really good dividend stock that's currently real inexpensive because they do have some real issues. But like always, you want to do your comprehensive research and due diligence on all of them. The FastGraph tool just makes that easier. Anyway, this has been Chuck Carnevale saying thanks for watching. If you liked the video, give me a like. Subscribe to the channel if you don't already. And take a look at subscribing to FastGraphs. It's a powerful tool that keeps getting better and better. And we got some really big, exciting things planned for 2024. Thanks for watching. We'll talk to you again real soon.